The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to bring someone back to the Rebel Capitalist Show. He is my good buddy, Jason Burack. Jason, welcome back, my friend.
Thanks, George, and I'm glad you're doing better. Everyone's happy that you're healthy again.
Yeah. Like we were saying, the eye, as people can probably tell, it's like, it's weird. It's like I've got a glass eye right now because it's still kind of swollen and everything, but we're getting close to 100%. Definitely, I'm back to a point where we can crank out the content. There's a lot to talk about, man. Holy cow, what's going on right now in the UK? Last week, they went from doing quantitative tightening. They got about a week of quantitative tightening in before they had to reverse and do QE. That's got to do a lot for their credibility. and then you got Credit Suisse and Deutsche. What's going on, buddy?
The entire global economy cannot handle the strong dollar, cannot handle rising interest rates, cannot deal with high energy and electricity prices, cannot deal with rising interest rates and all these problems. So all these cross currents together, it's just too much. It's the inflation, stagflation, all these problems, rising interest rates, strong dollar. It's just too much to deal with. If there was only one of these problems, it would be a lot, but you have 4, 5, 6 big problems. And if you're a business owner right now, we've had record amounts of asset price volatility. These central banks are causing insane amounts of distortions. I've been saying now for the last couple of weeks on my YouTube videos and also in other interviews that we're going to have just really shorter artificial boom and bust cycles. And it's all because of government and central bank policy. So if the central banks decide they want to keep raising interest rates, they're going to break more things. If the Fed decides they want to keep raising interest rates, they're going to crash home prices even more. They're going to destroy financing for small businesses. They're going to destroy the credit markets even more than they already are. They're going to prevent growth, any growth, and they're going to cause even more firings and downsizing, as the large corporations like to call it, from big tech and these other companies. So it's going to get worse before it gets better. It just depends on the policies, because now I think I just saw in the last couple hours, the United Nations is begging the Federal Reserve to not raise interest rates anymore. So
yeah, I saw that.
So you're having some of the elites like these global policy people, the Davos crowd, start to beg, don't raise interest rates anymore. But the dollar is already, it's a global margin call. I was actually making videos, George, in 2019, calling it the dollar wrecking ball.
Yeah.
So I was doing these videos in 2019, calling it the dollar wrecking ball back then. So, and then with Repo Madness. So in 2019, a lot of the similar things that are happening now happened in 2018, 2019, the last time the Fed did quantitative tightening. And
yeah, but we didn't have 9% CPI or 8% CPI or 9% in the UK, right?
Exactly. And that's destroying the consumer. It's destroying savings. You have record amounts of credit card debt now, and people are not using the credit card debt for frivolous things. They're not using the credit card. The spike in the credit card debt is not for buying the latest tech gadget, the newest iPhone. Apple sales are collapsing, even though their costs are going through the roof and they're having supply chain problems. And a lot of the factories in China either don't have electricity or they're out of parts.
Yeah, they had to stop making iPhones. So that to your point, that shows you that the boost in credit card use isn't because the economy is booming and the consumer is strong, or else you'd see the iPhone sales through the roof. You see the iPhone sales plummet to where Apple literally has to shut down manufacturing. They said, no, we've already got too many. We're not seeing any sales. So this would lead you to believe that the boost in credit card spending is going to pay groceries, pay rent, and put gas in the car.
Exactly. It's to make ends meet, to cover all the cost increases from mortgage payments, rent, electricity bills, gasoline, diesel, food, healthcare insurance, all the basics. The consumer is distraught. I'm actually seeing, like in the survey data, you're seeing people with 6-figure incomes, and I'm seeing these articles that people are making over $100,000, hundreds of thousands of dollars, and they are living paycheck to paycheck because they didn't manage their spending correctly, because they assumed because the Fed has basically created this, and other central banks, but mostly the Federal Reserve Bank, has created this Pavlovian response up until recently, but basically for the last 15 years, that asset prices only go up, that home prices only go up, that they've inflated stocks, bonds, and real estate for so long with zero interest rate policy or ZIRP and quantitative easing, which is just fancy for the central bank expanding their balance sheet and buying bonds. And you wanted to talk about Europe. Well, the European Central Bank, a lot of people aren't aware of this. They actually, on a percentage basis, they did more quantitative easing than the Fed did from 2009 to 2019. So the percentage purchases of their QE programs, my buddy Daniel Lacaille, who's a hedge fund manager in Europe for many, many years, he writes articles for the Mises Institute. I was interviewing him for years prior to the pandemic about this, and he was writing articles about this, about European zombie corporations. The European Central Bank was subsidizing purchases of European Union government bond debt and European companies. So yeah, if you pull up a Bloomberg terminal and you look at the financial statements, the balance sheets of a lot of these European companies, they do look cleaner with less debt. A lot of them do, than a lot of American companies, but that's because, George, the European Central Bank was buying the debt for years, was subsidizing. They had negative interest rates for years.
Yeah.
So
and
the
they're
European
indiscriminate buyers, so they'll buy at any price. So the market would require a higher, bigger risk premium.
Well, not only that, but you had all these hedge fund managers and the investment banks in the European Union, and they were front running the purchases with leverage by the European Central Bank. So they knew that the European Central Bank for about a decade was drastically expanding their balance sheet and buying this garbage. So these European corporations and European governments just issued more and more debt that the European Central Bank was buying. So it just created more moral hazard, more distortions, and then eventually led to more problems. But the European Union is dealing with much, much higher electricity and energy costs. That created the problem. You have inflation, and you have enormous amounts of inflation. And now you have the problem with currency devaluation against the dollar, and then rising interest rates. And that's what created the problems in England in the last 10 or so days, is these pension funds were so desperate because of Fed and other central bank policy lowering the interest rates. These pension funds, historically, they have a large proportion of investments in government bonds that would have generated, 4 to 8% interest payments on the bonds. So they could have earned that fairly risk-free in the past, prior to the 2008 financial crisis, with zero interest rate policy. But because of central banks, especially the Fed, committing to Japanification and asset price inflation and lower interest rates, you had these pension funds that were desperate for income, and then they got suckered by these flashy salespeople from investment banks, from hedge funds, from private equity, into all these kind of crazy, exotic, quote unquote, investments. In a lot of cases, they're not really investments. They're risky bets that were labeled as investments. The largest pension fund in the United States, I believe, is CalPERS.
Yeah.
For sure. I did videos on this, George. They were issuing press releases in 2019 bragging that they were leveraging up their entire assets under management, their pension fund balance sheet, 20%, to make investments into private equity, hedge funds, and real estate.
Yeah, and SoftBank.
well, SoftBank is not a bank, except they use junk bond financing, and they went and made insane amounts of risky bets on revenue only growth, non-profitable technology companies in Silicon Valley and China. But now you're seeing the tech bubble in Silicon Valley and in China burst.
Yeah, remember WAG? Remember that company that they bought for or they invested at a valuation of 300 million, and it was a dog walking app?
There's so many bad ones. Well, but they took advantage of yield-starved investors in Japan that were desperate for any type of yield income, because the Bank of Japan and Japanese government was doing Japanification, manipulating interest rates, and their national debt's so large they can't even afford a 1% rise in interest rates. They've had a record currency devaluation occur recently in the last 4 or 5 months.
Yeah, and then the argument there, Jason, with the pension funds is always, oh, well, it's no big deal. Going back to the bonds, the government debt, saying, oh, it's no big deal because they can just hold to maturity. But to your point, they bought all that debt with leverage so they can get a margin call. And if they get a margin call, then obviously they can't hold that to maturity, and they have to take a big haircut, which is why you saw the Bank of England go from quantitative tightening immediately to quantitative easing. Even though they have high rates of inflation, it shows you that if push comes to shove, they're not that hawkish. They're going to bail out the financial system before they try to put out the consumer prices continuing to rise. So I guess the next question is, do you think we're going to see that in the United States? Do you think we're going to have a credit event here, especially at the long end of the curve? The short end of the curve has all the demand in the world. I mean, they've got massive amounts of demand at the short end, but not so much at the long end. So do you think we're going to see the same thing here? If interest rates go up, pensions, maybe the Fed has to step in and go from being extremely hawkish and doing quantitative tightening to, whoops, sorry, we're going to go ahead and choose to bail out the system, as opposed to fighting inflation.
Yes, at some point. The timing of it's unpredictable, though. I mean, the Fed may try another couple interest rate hikes. The more at this point, though, the more the Fed raises interest rates, the more likely they are to crash real estate. And we're looking at, unfortunately, this is why governments and central banks, you can't have deflation for long periods of time, because deflation cannot be taxed. Okay, so that is the main reason we will not have deflation, especially post 2008. And especially over the last couple decades, when more and more of the US federal government tax revenue base is reliant on asset price inflation from stocks, bonds, real estate.
Right.
So in a deflationary environment, George, and we're already starting to see this, but we haven't seen this yet for government tax receipts, but let me just play things out. So we talked earlier in the interview about the consumer, right? If the consumer is not going out to bars and restaurants and going out shopping or spending online shopping or traveling, you're going to see income tax revenues and sales tax revenues. Those things will collapse. So those revenues will collapse first. And then you will start to see capital gains tax revenue. So we've had asset prices have a very nasty correction the last 6 months. So pretty much this is a very painful bear market. It's tough to say exactly how long it'll last. Tell me when the Fed will stop hiking interest rates. That's when probably the bear market will either slow down or end. And we're starting to see some nice rallies again from the oil price, although OPEC plus their production in August totally collapsed, almost 4 million per day. Without OPEC actually even announcing production cuts, production collapsed from OPEC plus, almost 4 million barrel per day below projected targets. And OPEC is already talking, at least about a number of oil ministers have talked about drastic production cuts similar to 2020 soon. So in the next month or two, we may see big production cuts, strategic petroleum reserve. So oil and gold reacted to the potential of the Fed stopping interest rate hikes soon. But, the Fed, it has no good options. That's my point. So you brought up what the Fed's going to do. They have no good options left.
Yeah. And going back to your argument about the tax revenue, which is extremely valid, it's all about asset prices. And when you're talking about the Fed or the government can't afford deflation, talking about specifically deflation in asset markets. So I think they'd be okay if we had CPI running at 3 or 4, but yet, I should have said, they'd still see it as a big problem if we had the CPI at 3 or 4, but yet the stock market was down 50% and the housing market was down 50%, because even though they have that nominal inflation, that's still going to be a big hit to the tax revenue, because so much of the tax revenue now is dependent on asset bubbles and not the real economy.
Exactly. But the state and local governments still need the consumer. They are reliant, I would say, more than the federal government is, for sales tax revenues and property taxes. So the state and local governments will get a nasty hit if real estate crashes. They're already starting to get the hit from consumers not going out. They don't have the discretionary income. They don't have the savings. They're using credit card debt for the basic necessities to make ends meet. But the state and local government tax revenues are going to get hit first. Now, they were flush with cash because of property taxes. So over the last 12 months, you've seen record amounts of tax receipts from a lot of state and local governments, but that will shift because the state and local governments historically do not keep a lot of cash on hand. So even though they had record tax receipts, normally what happens with these politicians and bureaucrats is when they do have windfall tax receipts, they do not keep any cash on hand. They find new pet projects to spend it on: ESG, infrastructure, unbid government contracts, corruption, waste, fraud, corruption, and abuse. I mean, it'll be labeled as some benefit to the public.
All right.
California has had many boondoggles. They were supposed to have built these bullet trains from, I think, San Francisco to San Diego. I think they spent $80 billion on a very short amount. I don't even think it's finished yet. Over 80 billion on just one stop on the bullet train. So total waste, fraud, corruption, and abuse. That 80 billion, I think, was supposed to cover the majority of the entire project of the bullet train from San Francisco to San Diego. And it covered, I think, about 30 miles. from I think Sacramento to Bakersfield or something like that.
Yeah.
That's how wasteful.
Well, Jason, you didn't hear what they're going to do? Oh,
No.
what they're going to do next is they're going to buy 10,000 of Elon Musk's humanoid robots to finish the bullet train project.
Oh, really?
I'm kidding. I'm kidding.
What about his fleet of robo-taxis that were supposed to be profitable? He was saying how his robo-taxis were going to be profitable. So if you made an investment in a robo-taxi, it was going to pay for itself within a couple of years, and it was going to be pure profit afterwards. Not counting any of the maintenance of property, plant, and equipment. I mean, the CapEx bills are going to be massive for a lot of these businesses going forward because all the cost increases. You're just seeing this with Ford, mining companies. All these companies are coming on their Q2 numbers. We don't have Q3 yet, really. The Q2 numbers were just ugly. And the Q3 are going to be even worse because the sales and revenues are going to be down. The costs are going to be up. So a lot of these companies are going to absolutely get beaten for earnings misses.
Yeah, let's go back to real estate. How do you see the residential real estate market playing out? You know, I always hear Gunlock say the Fed follows the 2-year. And if the 2-year is trading at 4.25, let's just assume for a moment they take Fed funds up another 125 basis points, and there's a 1-to-1 ratio with the mortgage rates. I think that puts 30-year fixed at like 8.25% when we're already seeing cracks at 7%. So how do you think the next, call it, year plays out with residential real estate?
It is very ugly. Each week I go to dinner with my best friend who's a successful real estate agent in the DC metro area, and I was asking him how the market is here. And normally this area is pretty recession proof.
Yeah. And
he was straight up saying like, the interest rates are over 7%, even for people with pristine credit right here. And they're advising customers not to buy, to wait it out, to wait for the Fed to lower interest rates, because when interest rates are this high, there's not a lot of people that have the credit and the income and the amount of income, they can't get financing. So right. This is creating a lot less demand. I mean, there's still people that can pay all cash, but they're not buying into a market where property values go up. So if the Fed hikes interest rates, property values can fall. So all cash buyers or people who only need a fraction for the mortgage are not buying. So the Fed has created, I would say, the type of mentality right now where buyers are very apprehensive. People are waiting. They're very scared to buy.
What do you think about the dynamics on the supply side with interest rates going high enough to where Blackstone starts selling a lot of their properties because they can get a better yield with a 10-year treasury or a 2-year treasury for that matter?
I mean, people are going to start being contrarian and they're going to start looking at bonds. They're going to start looking at gold, what's hated, what's cheap. So real estate is not hated and not cheap because it's been in a bull market for so long because interest rates were lower. Now that interest rates are higher, there's not as many people that can get financing. There's not as many buyers. So there's all these sellers now that are looking to pay closing costs. People are getting out. So people are going to be looking at potentially if they can earn a quote unquote risk-free, although with the real inflation rate, are you getting a real return with the US Treasuries then? So you're getting devalued less than if you're getting an interest rate there. So people are going to start looking at gold, and treasuries are going to start looking at potentially a barbell trade. There's a lot of people in cash right now, but the longer you hold cash, our governments and central banks, they're going to want to inflate away this debt still.
Yeah, it all depends on what your expenses are denominated in. Because if your expenses are denominated in yen and you're holding dollars, you're making out like a bandit, even though the CPI in the United States is 8.3.
Also, if you hold US dollars for 6 months or 12 months and stocks, the Q3 earnings are bad and there's bargains for a lot of these commodities play, the base metal miners, George, are starting to look very, very attractive.
That was my next question. Let's talk about the gold miners.
Oh, gold miners. Okay. So we could just talk about commodities in general, but yeah, the gold miners, their margins, some of them are still $200, $300, $400 an ounce, depending upon cost. We don't have the Q3 numbers out yet for a lot of the gold miners yet, but a lot of the gold miners for Q2, the costs were $1,200, $1,300 an ounce. They're still rising though. The problem in these emerging markets is you have their currencies devalued a lot against the dollar. So you still have cost pressures, enormous cost pressures, stagflation. You have workers' protests all over the globe, mostly in emerging market countries, for high energy, electricity, diesel, gasoline. The workers want higher wages to offset, at least somewhat offset the inflation problem. So that's going to affect a lot of these mining companies because the majority of these mines are not in the United States, Canada, Australia. The majority of the mines are in emerging markets, developing countries, because of there's less rules and regulations in a lot. In the European Union, George, one of the major reasons for their energy and electricity crisis is because you had misallocation of capital and oil and natural gas drilling bans. So it's not because of free markets, it's not because of capitalism that you have this electricity crisis and energy shortage problems with natural gas and nuclear power plants being shut down. It's because of bad policies for over 15, 20 years in the European Union and United Kingdom. So the free market could solve this eventually. If you spoke to business owners and said, if the natural gas price was this high, they'd be like, of course, we're going to start now drilling more. We're going to build pipelines out. But the politicians, the bureaucrats, the regulators, the pro ESG people at the Davos crowd and the academics, they've prevented all of this. And that's why you have all these problems in the European Union. Right. And then you're looking at bailouts. And then the banks are holding the loans for these companies, and you have manufacturers that can't, their energy costs and electricity costs are so high, it's not worth them manufacturing.
Yeah. So the bottom line there is the cost for these gold mining companies are increasing significantly because a lot of them are in the emerging markets, so they can get around all these crazy regulations that you have in the United States and in the EU as an example. But again, the downside there is they're dealing with the dollar wrecking ball. So this is why I don't want to put words in your mouth, but I'm assuming this is why some of those gold miners are so cheap right now, even relative to the price of gold.
Well, you have a lot of people worried that the more the Fed raises interest rates, the stronger the dollar gets. And in the short term, you have these global macro hedge funds, these high frequency trading algorithms. The more the dollar rallies, the more these programs, they're straight up programmed. Dollar index rallies, short gold, short paper silver, short mining stocks. So that's just short commodity prices. Now, there will be a limit to this, though, because if the commodity price gets low enough, you're going to have supply destruction. So I just hear all the time mentioned that demand destruction. Well, George, if things continue at this pace and currency weakness in emerging markets, the other major issue besides workers who want higher wages is the cost of diesel, the cost of electricity, the cost of energy. That's the major problem for miners. Miners, about 30% of their costs, roughly 30% of their costs are energy, and they can't really. Some of them had some hedges on diesel. Some of them had some hedges on gasoline. They cannot lock in long-term electricity prices for long-term. So even if they built like a local electrical power grid, they're still subject to rising electricity prices eventually. So yeah, maybe they lowered their costs a little bit, but if their input costs are that high with energy and electricity, diesel, these things are going to hurt mining companies, especially because their margins are getting killed. So for commodities exposure, what I prefer commodities exposure without capex risk. And those are the royalty and streaming companies. There's actually a non-precious metal royalty and streaming company. It's the best one. And they just increased dividends by 14%. I have an article on it for patrons behind the paywall. I wrote it about a month ago. So that's looking attractive. They have royalties on coal, potash, base metals. What company is that,
Jason?
Huh?
What company?
You want a stock pick? It's Altius Minerals. So they have strong Altius Minerals, 14% dividend increase. That's a non-precious metal royalty company.
And people can find the details on your Patreon, right? Mm-hmm. Okay, cool.
But you have to be careful if you're buying in a mining company, though, because I just spent last week. No, it wasn't last week. It was 10 days ago. I spent over 3 hours going through some of the low-cost silver miners, and their costs are just going out of control. So the base metal miners, the silver miners, a lot of these guys over the last 2 years, their costs are just up so much. The metals prices are down, especially silver, because silver has been one of the worst performing metals. Even before all the commodities futures prices crashed, silver was not doing well. But now you have a lot of these base metal mines and silver mines, they are running cash flow negative.
Right.
So over the next 6 to 9 months, the miners will either have to shut off the mines, they will put them on care and maintenance, they'll have to merge, or they will have to go bankrupt. and then there will be supply problems or supply destruction. I hope I'm wrong about this, but if the Fed keeps raising interest rates and we have further problems, we could have a scenario where we have some demand destruction for base metals, but also supply destruction too. So if you have demand destruction and supply destruction together, it would be total chaos.
Yeah, but I think the main takeaway there is in the next few months, there could be some great opportunities
Oh,
with those
yes.
companies, but you can't just go out and buy an ETF. You've got to be,
Well,
we got to go back to being a very good stock picker to pick out the balance sheets that are going to survive the downturn.
so an ETF is not going to go to zero, George. And if one or two of the companies in, say, a copper miner ETF, COPX, which is down, I think, roughly 40% in the last 6 months. So if a couple of companies go bankrupt in a copper miner ETF, they replace them. So there's survivorship bias. If you're picking out individual stocks, you have to be very, very careful, because if metals prices keep going down, capital's not available to a lot of these miners. If their costs keep rising, you have to pay a lot of attention to this. You either have to pay for a newsletter or do a lot of balance sheet analysis yourself. You have to look at profit margins on the income statement and see how that affects cash flows in the balance sheet.
Or just got to subscribe to Jason Burack's Patreon page. That's the best solution right there. All right, buddy. We're going to try to keep it short here with this new format that we were talking about. So tell everyone where they can find you on social media.
Sure. My YouTube channel has almost 2,000 free videos and almost 50,000 subscribers. Hopefully my birthday week this week will get over 50,000.
Happy birthday, buddy. I didn't know that.
Thanks. Yeah. Yeah, my birthday's in a couple days. Hopefully my YouTube channel will get over 50,000 subscribers with this interview, and my Patreon page. I have almost 250 in-depth articles behind the paywall on a lot of interesting companies and sectors. It's mostly commodities now, but if something gets cheap and hated, I'll start looking for it. So 3D printing or something else that where the companies have a lot of growth potential, the companies are making money, the market hates them too much, that actually interests me. So I normally ask what's cheap, what's hated right now. It's the gold stocks, the low cost gold stocks, the royalty and streaming companies, which are commodities exposure without CapEx risk. The royalty and streaming companies, the larger and medium sized ones, are looking very attractive. There's some small and medium sized royalty and streaming companies, precious metal ones with gold and silver streams on lower cost mines that are 10 times cash flows or less right now, and they have dividends. So those are looking interesting. And we already talked about the non-precious metal royalty one. Oil and natural, I still think there's a long-term bull market, George, for oil and natural gas. I think there's a food and energy crisis. A lot of it's because of bad policy from governments and central banks, and that's not going away. There's a lack of investment on the supply side for nuclear power. Japan and France are going to be restarting, I think, their nuclear reactors because they can't afford the energy imports. They're too expensive over the next 12, 18, 24 months. So I think there's a lot of opportunities for food and energy, and then base metals and precious metals.
Yeah, I agree. So for the YouTube channel and the Patreon, is it Jason Burack or is it Wall Street for Main Street?
The Patreon is patreon.com/Wall Street for Main Street. So WLSTFORMAINST. It's only $5 a month. So it's just to cover my overhead costs. I can pay my bills. I'm not trying to get super rich off of this, just making sure I can, pay my bills and keep grinding out content. There's a lot of interviews with experts. Actually, that's where I found out about Credit Suisse and Archegos. I was speaking to hedge fund managers, and I talked about this in interviews with you over 6 months ago. And I was warning people, if you go back in the archives for your interviews with me, I was warning people about Credit Suisse and Archegos over 6 months ago, because I was having conversations with hedge fund managers who were short Credit Suisse and were telling me that the loans Credit Suisse had over 30 billion in loans to Archegos. I think they only wrote off about 5 billion, which was
that's what I read today, 5 billion.
Well, supposedly from my discussions with hedge fund managers who went short the stock 9 months ago or 12 months ago, they started their short positions on Credit Suisse, that Credit Suisse had a lot of loans out, similar to Archegos, to other hedge funds and family offices. Deutsche Bank has done these too big to fail banks. Their derivatives positions are bailed out or saved by the Fed and the European Central Bank through secret bailouts and other currency swap lines. But Deutsche Bank, a lot of people don't realize this, since 2009, they've done reverse stock splits. So these bankers and governments and the central banks, they always come up with tricks and rules changes as part of stagflate tax light to keep the banks alive, like zombie banks.
Okay, so Patreon, Wall Street for Main Street, YouTube, Wall Street for Main Street, and then Twitter's Jason Burack, right?
Jason E. Burack. There's actually another Jason Burack. I think he's a dentist, and I think he also trades stocks. So that's not me.
All right, buddy. Great info. Awesome conversation. Can't wait to do it again.
Great. Thank you. And I'm glad you're feeling better, buddy.